I'm Brian Beaulieu, and welcome to this November 10th edition of FedWatch. Three really not so interest rate, inflation-related items, but two other points I want to touch upon first. And that is, we're getting the question a lot, the Israeli-Hamas war. Is that a threat to our economy? And it's not a direct line. It's not an immediate threat to our economy. As we've been telling people, it's a threat only to the extent that oil prices go up because the war spreads or there's an oil cutoff or something like that. And none of that's happening right now. Oil's been fluctuating where it was before the war. There's been nothing very strange going on there. LNG exports to Europe from the United States in 2022 were double what they were in 2021. So that part of the angle is covered. So we don't see it as an immediate, clear and present danger anyways to the US economy, certainly not in a recession driver. And on a piece of good news, it was noteworthy that the 30-year fixed rate mortgage dropped 25 basis points in a week, last week. Big drop in the 30-year rate. Doesn't mean it isn't going to go back up, but there is some breaking action going on in those interest rates, which leads me into the Federal Reserve. And there I want to really bring 3 points home. The first point being Wall Street and beyond Wall Street seems to be building in the probability that the Fed is going to lower interest rates in 2024. And then indeed, the central bankers of Europe are going to be lowering interest rates in 2024. If you haven't already heard it from another Trendscast or podcast, Europe is already slipping into recession. Our manufacturing here in the United States is running just about zero growth and showing some signs of weakening. New orders are weakening, all of which is going to give the Fed real serious pause, we think, in December about raising rates one more time. And obviously, as things soften up more in 2024, they are likely to lower interest rates. And I mentioned Wall Street just a moment ago. They're building in a 100 basis point decline as probable for next year. The Fed has already said that they'd be willing to do 100 basis points, and I think that's probably a little light. They'd probably be doing a little bit more than that. Keep in mind that given the yield curve status today, even 100 basis points gets us back into a normal yield curve situation. So the sooner it happens, the better. Most folks, and we're one of those in that category, think either 1Q or 2Q24 will start to see those interest rates come back down. And let's just hope that it comes down relatively quickly to minimize the damage that these high interest rates are doing. Second thing I wanted to mention, this came into my head while listening to Chairman Powell's briefing on what their thinking is and what they're looking at. He talked repeatedly about robust consumer activity and the strong GDP number in the third quarter. And if you saw our executive summary, and I'm not going to reiterate that whole executive summary from the October issue, but it wasn't as strong as it looked. A lot of it had to do with personal consumption expenditures to stay in your house, rents, utilities, transportation, even healthcare was a major contributor. And the second largest component driving that GDP number was an increase in inventories. And we're seeing that across the board, both in the macro numbers and in our client data. Inventories are a problem, and that's a plus for GDP because it represents an investment. But it's a negative as far as you and I know in business, because we have to drain excess inventories, which means we are going to stimulate sales somehow, or we're going to cut back on production. Indeed, we are seeing those layoffs in the production sector, as I mentioned 2 or 3 weeks ago. So it wasn't nearly as robust, and I even broke down some of the rate of change comparisons. I mean, you could look at something very strong like automobiles, and that clearly had a nice upside impact on GDP. But that's a one-off. That's not a sustainable number at 16.2 or 16.8%. You look at something that's really bread and butter, like e-commerce, that grew at a 7.7% clip. And what's normal pre-COVID was 14.2% clip. So even that, well, it sounds like a great number. We're really seeing a slowing down in the consumer's desire to spend. And I'll be able to flesh this out more in coming weeks, but the early take on some of the October data, particularly amongst the leading indicator data that we're already looking at, is showing signs of weakening. We're not changing our forecast. It still looks to us like GDP will be down a couple of quarters and the overall economy is softening up for 2024, and we are going to see the Federal Reserve actively lowering interest rates in 2024. Those estimates right now are all over the map. We're going with that about 100 to 150 basis point decline in short-term interest rates, and that's likely going to get us that normalized yield curve that we need. That's what we're looking at right now. Don't like the inventory numbers, as I alluded to. Don't like what really drove GDP. And I didn't mention to it what was really driving GDP also in the third quarter was state and local government spending was way up and federal government spending was way up. Neither of which is the stuff that is really going to make for a blockbuster quarter that tends to be relatively transient activity. So don't be swayed, don't be beguiled. From our perspective, we're going to get the softening. Interest rates are going to be coming down, and you'll find that about a year from now, beginning at least a year from now, maybe 18 months from now, if you're really trying to time the market, you'll find more attractive interest rates with which to go out there and make things happen for the rest of 25 and for 26, 27, 28, and 29. Don't lose sight of that prize. Thanks for watching this edition of FedWatch. See you next week.